Yvette Butler, we've seen volatility really spike since Labor Day. I'll assume a lot of your customers are getting nervous. So talk about whether or not you're getting a lot of frenzied phone calls and what are you telling your clients?
Well, every year after Labor Day, markets and investors really re-engage. Summer's over, kids are back in school, and it's always a great time to check in, and there's usually some level of volatility. So we expect to hear from customers at this time of the year, and we are. And they're just asking questions around, what does this volatility mean? What does it mean for my portfolio? And should I change anything? So we really encourage people to have a plan. And we think of customers in different categories. Some of them are really comfortable saying, hey, don't worry about the volatility. Let's check in once a quarter. And let's just stick to that plan. And others really need for us to call them when there's something that might impact their portfolio or have us there to kind of coach them through the current volatility. So we try to really adjust to meet the needs of the customers and where their kind of level of comfort with the volatility and the risk really stands.
And what about the idea of low volatility funds? Because this has been a very popular product this year. Are you counseling your clients to move into those type of funds?
Well, at Capital One Investing, we really try to actually avoid popular products. We really believe very strongly in a core strategic portfolio. So we think that's the heart of a diversified, well-balanced portfolio, is the heart of a sound portfolio management success. And we, for example, educate our customers in we don't want any part of your portfolio to be too overweighted with securities that move and react to the market in the same way. And that's really what the balance is about. You want a diversified portfolio because it lowers your risk, it focuses in on the long term, and again, if you have that core strategic portfolio, primarily based in ETFs, and then we can round it out with other securities for increased upside or to balance the downside.
That said, because of the worries about rising rates and valuations in the bond market being so high, are you finding clients when they're calling you about the stock market volatility saying, I can't go to the bond market either because it's priced too high?
Absolutely. I mean, we have customers who are, for example, in retirement or nearing retirement and are looking for income, as you're describing. And we always tell them that you have to check what's available in the market. We have a broad array of products that can help consumers. So again, it really depends. And then there's consumers that are our millennial customers that, again, see this volatility as an opportunity to potentially buy or sell. So, for example, we did an investor check-in this summer when there was also a period of volatility, and we found that 25% of the respondents say they use these times of volatility to either consider buying or selling. So just really want to make sure that we coach them through that time and make sure we're buying and selling for the right reasons.
All right, so this is a gut check for investors. It helps them learn their own risk tolerances.
That's right, that's right. And that's the value of having an advisor, someone who's been through these cycles before, because if you're new to investing, this might be the first period of volatility you've ever seen. And it's really expected. So again, we encourage people at this time of year, for example, to make sure you've opened your IRA, make sure you've maxed out your 401k, make sure you've checked in on your retirement plan. It's just a good time of year to do that basic care and feeding of your portfolio. And that volatility is just a normal part of being a long-term investor.
All right, there's the positive outlook. Thanks a lot, Yvette.
Thank you, Greg.
And thank you for watching The Street.